December 10th, 2024. I kind of wanted to start off by talking about this right here. The fact that we've had, a pretty long bear channel. On the 5 minute chart, usually channels only last, 2 days, 200-ish bars. And you can see over here, we have a channel that started on Friday on basically bar 7. And we went all the way to essentially this area, and that's a 236 bar channel. Wasn't really a very large drop in price because the daily ranges have been really small and the channels in general haven't been all that strong. But it is notable that it's been a really large channel. And you have to think about the market cycle, spike, channel, trading range. And so if we're not in the spike phase and we're really deep into the channel phase, what do you think is likely to come soon? Probably the trading range phase. And so, really long channel and then this bounce at the end of the day, probably tomorrow will be a trading range day. It probably will not be a bull trend day because the odds of a strong breakout above this channel, even if we got a good looking bull breakout tomorrow, it would have to break the trend line and then pull back and form some sort of higher low or lower low major trend reversal. So odds are, even if we get a good looking bounce tomorrow, it'll end up failing and pulling back, and we'll try to form some sort of major trend reversal if we do get a good looking bounce. But the reality is, most likely, we're going to enter some sort of trading range for at least the next couple of days. Bar 1, a big bear bar closing near its low. You could argue it's 3 legs down. Sorry, I'm moving the chart around so much, but you could argue it's 3 legs down. 1, pullback. 2, pullback. It's climactic 3, except for the fact that the first and the second leg have 20 to 30 bars each, and this is just 1 bar. So it's not quite as good as it could be, but still reasonable to think that that's a third leg down, and you're buying some sort of truncated wedge if you're buying above 2. 2, it's one of those, in my folders, the 1 in 3 chance that it's the high of the day or the low of the day. I think, maybe 30% chance that 2 is the low of the day, but it's really not great to be buying above such a small bar. If you want to, it's very much an if you want to trade. You can buy above 2 and just take a chance that you get 40 points to the upside. And you're only risking 3 points, so it's not unreasonable to do that. But the thing you have to ask yourself if you're taking that kind of trade is, are you going to take that trade? If you lose that trade the next 6 times you take it, are you going to take it the 7th time? Because if you're not going to, then you can't take that trade. Because the thing about these low probability trades is you have to take every single one. So if you're going to buy above 2 and then we get the same pattern tomorrow, you've got to buy it again. You have to take those low probability. You have to take all of the low probability trades if you're going to take the low probability trades, because of the fact that you will inevitably pick the ones that do not end up working and miss out on the winners, because none of the low probability trades look all that good. So you can buy above 2. The main problem I have, well, obviously the low probability thing, but I'll start with this. 3 consecutive bull bars, so 2, 3. 3 is able to close on its high, so it's possible we're going at least a little bit higher. The main problem I have with buying up here is the fact, the thought about yesterday's low. The bar 81 close is near yesterday's low, so yesterday's bar 81 is near the low. What does that mean? Why does it matter that it's that way? The reason, I'm just going to use the extended hours for this. The reason is because if it's a bear bar closing near its low, then it's a sell signal bar. So that bar, that 5 minute, it just looks like the day closed near its low. But you have to keep in mind, on a daily chart, that's a bear bar closing near its low and probably some sort of sell signal bar. So you have to be thinking, we're probably going to have to test below that low, because bears are going to want to trigger the sell signal bar and try to get the market to go at least a little bit lower. So you'd have to imagine we're probably going to try and get below yesterday's low at some point today. So that probably also slightly decreases the chances that we get back to, or that bar 2 and 3, is going to lead to a big bull trend. 4, another bull bar. You have to keep in mind, 1 probably needs a second leg. So there's probably sellers somewhere above scaling and higher. And obviously a large tail on 4 is rather disappointing. We'll probably pull back to at least the bar 2 high, the breakout point. 5, a big bear bar, probably buyers in this area. This looks like the second leg down. And 2, 3, and 4 is a leg 1, and it should also get a second leg up. 6, a big bull bar closing near its high. You buy above 6. It is a double bottom. I get that, but big bar, big risk, and it's really not all that great. You don't want to risk that much this early in the day when you're not really sure of the day structure, and the odds are against some sort of huge bull trend. So could you buy above 6? Maybe, but you have to be quick to get out. You probably don't. If you bought above 6 and you got stopped out below the low of bar 6, then you probably didn't manage the trade correctly. And quite frankly, if I was buying above 6, I would want bar 7 to look exactly like bar 6. And if I bought above 6 and 7 looks like that, for me, that's a sign that this is probably not going to go nearly as high as I want it to, because I understand I find myself now saying the things that I would hear a few years ago and not really understand, and that's one of them, right? Because 7 is follow through. It is follow through for 6, but 6 is a risky trade. It's big bar, big risk early in the day. It's not really, in general, a super bullish environment. It's more of a trading range environment, and taking big risks in trading ranges isn't necessarily a good idea. So, 7 with the large tails on the top and the bottom, um, probably not the best. 8, a doji bar, not really that great of follow through again for the traders who were buying above 6. Disappointment 7, 8, but probably buyers below 8 willing to scale in. 9, buyers below 8 during 9. Obviously, you don't want to sell below there, so we should go at least one tick above that. 10, a big bull bar. Good for the bulls, but could be 3 pushes up. 1, pullback. 2, pullback. 3. Really not that great to be buying up in this area at the new high of the day. So probably sellers about somewhere up here scaling in higher. 11, a bear bar, but a large tail on the bottom. Do you want to sell below 11? I probably would not. It is 3 legs up, but it's really not that great of a wedge. You need to, the most important thing, this is what trips people up for years, I personally think, is you get really good at identifying patterns, and you think you just have to know how to look at the pattern in order to trade it properly. You can think that, traders will look at 11 and they'll think to themselves, oh, it's a wedge. Great. I know it's a wedge. Therefore, I can short it. And that's not true at all. Just because it's a wedge doesn't mean it's a good wedge. There are so many other variables that go into it. So you have to be thinking less about the pattern. It's easy to say, okay, 1 push down, pull back, 2 pushes down, pull back, 3 pushes down. Okay, this bull bar. Okay, 28's a wedge. This is a wedge. Yeah, you're not wrong. But this is a tight channel down, which is a breakout on a higher time frame, and we're still probably going to go below the slow. So you can buy, if you buy above 28 and you're confused as to why you got stopped out, it's because it's not a good trade. You're thinking it's a good trade because you correctly identified the pattern, but correctly identifying the pattern doesn't really mean anything if you're not, using it properly. So you need to learn the difference between chart reading and trading. And chart reading is just learning how to identify the proper patterns, and trading is learning how to put those skills to use. 12, a bear bar closing near its low, up possibly on a lower time frame, a nested second leg trap, down on 11, up on 11, and then down on 12. So 2 legs down, probably buyers in this area willing to scale in lower. Outside up 13, good for the bulls. Maybe we're going at least a little bit higher, tight channel up, but again, it could be 3 legs up. First leg to bar 4, pull back 5, 6 through 10, second leg, pull back 11, 12, and then big bull bar 13. 14, a bear bar, but a large tail on the bottom. Probably buyers somewhere below, scaling in lower. 15, a bull bar, probably sellers above, scaling in higher. The bears who are scaling in, selling highs on limit orders are making money, but the bulls who are buying on limit orders are making money as well. Ultimately, you have to think to yourself, you have to zoom out mentally a little bit and think to yourself, what does this look like? Does this look like the start of a strong bull trend? Keep in mind, this is the start of a strong bear trend, right? This is the bear spike. You could argue this is the bear spike, pullback, and this was the bear channel, not the other day. That would be a reasonable argument. And you could think that we have a little bit more of the downside, but this is the start of a strong bear trend. Does this look the same? No, it doesn't. It looks like a leg in a trading range. So to me, 2 through 15 looks like a leg in a trading range, the same way that looks like a leg in a trading range. 16, a doji bar, probably buyers below, scaling lower. Again, I wouldn't sell below 16. It's one of those low probability trades where if you do it, great, good job today, I suppose. But it's better to just wait for 17 and 18 because you're just going to get stopped out too often and not necessarily always be able to take the trade. So you can, in theory, take any trade or any bar for a low probability swing trade. You could, in theory, just sell below 16, call it a wedge, and bet that we're going to end up going lower and sit on your hands the rest of the day, which you definitely could do. But you're a person, you're not an algorithm. So are you going to take this every time if you lose it 8 times in a row? I don't know. 17, a bear bar, a tail on the bottom. You could sell below 17 for a second leg down, but we're probably going at least a little bit lower. 18, 3 straight bear bars, 16, 17, 18. I am expecting a second leg sideways to down from these 3 straight bear bars. 19, a bull bar with a decent close. Probably sellers above if we go above, but still 19 should get a second leg up the way 16 through 18 should get a second leg down. And then you get a surprise down on 20. 20 is the second leg down for the bears. Probably the too low is not going to hold as the low of the day, and we should get below yesterday's low. And this is, the thought of yesterday's low and the fact that it's a sell signal bar, I think is really important for bar 33. I used to take trades like bar 33 all the time, and I'm going to mention, talk a lot about that when I get there. 21, buyers below 20, and a bull bar, but a large tail on the top. An inside bar, low 1 short, bar 22. An outside bar, 23, outside bar 24, so consecutive outside bars. Probably buyers somewhere below, willing to scale in lower. 25, a bear close, a large tail on the bottom. Bulls trying to make some sort of, create some sort of tight channel. Or sorry, bulls trying to create some sort of reversal. Bears have a tight channel down. And then 26, another bear bar. Buyers below, though, at the bottom of the trading range. 27. 28, a bull bar closing near its high. I would imagine sellers above. And we do get sellers above during 29. Because, again, it's a tight channel down. There's going to be sellers. But probably buyers below, scaling in lower. It's not great to sell this low 1 at the bottom of a trading range. 30, a bull bar with a large tail on the top. Again, not great to buy. An inside bar, 31. Probably sellers above, scaling in higher, but still possibly the bottom of a trading range. A bull bar, 32, but at the moving average. And then basically it fails and you get a big outside down bar, 33. So what do you do with 33? Well, 33 is a breakout attempt below a wedge, right? We have the wedge, you could argue, here, and it's a breakout attempt below, but it doesn't even go below it with 33. So if you sold below 33, you weren't even selling a breakout, really. You were selling the very bottom, and your risk was relatively large. You could still take the trade. It's a bear bar closing near its low, but you have to think about your calibrated expectation. If you're selling below 33, what are you hoping is going to happen? You know about yesterday's low. You know that that's going to be a magnet. So if you're going to sell below there, what are you hoping is going to happen? You're kind of hoping you're going to get a collapse to the downside, right? You want the follow-through bar to look like 41 does and get basically swept into a really strong trade. And then you get 34. Is 34 all that great to you? Does that make you think that we're going to go a whole bunch lower? No, not really. So what are your options? Well, if you're going to take a low probability trade with big risk reward or with big risk, so you're going to take a low probability trade, not really high probability that we get a big breakout here, probably better to wait and see if you get follow through. But if you're going to take a low probability trade at the bottom of the trading range, you probably want to get really good follow through. And 34 isn't really great follow through. And you could hold the trade and be hopeful that the next bar is a big bear bar, but a lot of traders don't want to do that because they're taking low probability trades. They're not hopeful. They want the trade to work immediately. And so on the close of 34, they buy back their short. And that's why the entry price, if you sold below 33, is essentially the close of 34. And that's why we didn't go a tick below it on 35. The bears bought back their shorts immediately when 34 did not close as a giant strong bear bar, and that's caused the bounce on 35. 36, bears tried to create a breakout pullback, but not really all that great. And then you can see bears bought back their shorts 37. This is the hallmark of trading ranges, right? You sell below 33, it goes above 33, you get stopped out, and then you just sit there and watch the market go the rest of the day. So that's why it's probably better to wait for follow through. 37, a big bull bar, a bull surprise, but again, a tight channel down, probably sellers above here somewhere, scaling in higher. 38, a low 1 short, good for the bears, but good looking bull bar on 37, so probably gonna get a second leg. 39, I would imagine probably sellers above the doji bar. And then 40, a bull bar, but really not that enthusiastic of a second leg. If you bought the close of 37, probably not that thrilled with 38, 39, and 40. We've been in a decently tight bear channel from 16 to 33, so not really that great. 41, a big bear bar closing near its low. So a failed breakout to the upside, now a big bear bar. We're always in short, right? We've probably been always in short most of the day. And realistically, if you think about it, we've been always in short most of the past couple of days, right? So the direction is always in bearish. Another easy way to look at this is to look at a 15-minute chart. I've been doing this recently, and just look at the always in direction of the 15-minute chart. If you get too chewed up with reversals, and you're looking at a whole bunch of charts, you don't even have to look at a daily chart, a weekly chart, a monthly chart. I go over those things, but they're not really not that necessary. You can just look at a 15-minute chart. And what does this 15-minute chart say to you? Well, we're probably always in short, right? It's reasonable to think that this made us always in short. We didn't really go to always in long anywhere in here. So I'd imagine the market is always in short. And look at this. Does it really flip the market to always in long? That's that reversal. No. So you can use the 15-minute chart for a little bit of clarity. But again, you're trading a 5-minute chart or you're trading a 15-minute chart. I don't know what you do. But you're trading, if you're doing what I'm doing, you're usually trading a 5-minute chart. Today was an exception for me. I did trade the 15-minute chart. All I did today was I sold the close of 25. Well, I sold the close of this bar. I don't know if it's exactly 25, but I sold the close of that bar. And I went for a measured move. And I just played video games all day. I didn't really do anything. I sold this close and I basically just went sat in front of the TV, didn't do anything, and just checked it every 15 to 20 minutes. And then we went all the way down. And that's always in style trading. And it's the easiest, the quote unquote easiest form of learning how to trade and sit through those pullbacks. So it's a really helpful thing to just get the gist of the always in direction on the 15-minute chart, and try not to trade against the always in direction of the 5-minute chart, but also obviously of the 15-minute chart. So 42 consecutive bear bars, probably going at least a little bit lower. 43, another bear bar, 3 straight bear bars. Again, this is strong enough for a second leg. 44, another bear bar, probably going at least a little bit lower. And then 45 closes at the new low. We get a close at the new low, so it's a breakout. But in general, when you get a breakout on a higher time frame, remember, we're closing below yesterday's low, and yesterday's low is a sell signal bar. So in general, when you get a breakout below the prior day's low, a sell signal on a higher time frame, the market pulls back first. So we did get a 2-legged correction. 46, a bull bar, but a large tail. An inside bar, low 1 short, 47. And then 3 more bull bars, 48, 49, 50. But obviously, this reversal is minor. 41 through 45 is going to get a second leg. And so that it's very likely that we're going to go at least 1 tick below the bar 45 low to complete that second leg. 51, a bear bar closing near its low. A pretty strong short, knowing that we need to get at least 1 tick below the 45 low. So you can sell below there. Stop above 50 is fine. I think you can just sell there, put a stop above, and that should be fine. 52, the doji bar. Not great follow through, but okay to hold short with the premise we're going lower below the 45 low. 53, another bear bar, a large tail. And then 54, consecutive bear bars. It's always in short. It's sell to close. You could have sold below 51, higher probability 54. Either way, always in short. You can just sell. 55, follow through. 56, doji. 57, more follow through, but a large tail. We might pull back soon. When you start getting large tails on bars, sometimes you're going to have to pull back, but it's probably a minor reversal. None of this really needed a second leg. Once you sold below 41, none of the rally from 46 through 50 or 58 through 63 really was clearly needed a second leg, or none of it clearly needed a second leg. So it was most likely that we were going lower the whole time. 58, a bull bar, but would you ever buy above 58 and expect to make money after this? No, probably not. So most traders probably selling above 58 or just holding short. You don't really want to buy above the bar with a large tail after a sell-off from 51 through 57 when we've clearly been always in short for hundreds of bars. 59, follow through for the bulls, but not really that great. This isn't going anywhere unless we start getting huge bull bars closing above the moving average. 60, another bull bar, but a doji. And then a bear bar, 61, a tail, inside bar, low 1 short, 62. You can sell, but we might get a second leg up to around the 60 close. So if I sold below 62, I probably would not put a stop here. I'd probably put it like above 52. We're just kind of somewhere arbitrarily 3 or 4 points above to make sure I give it a little bit of space in case we trade a little bit above the 60 high for a second leg up before we reverse down. But you can see 63 rallied to around the 60 close and then sold off. 64, a bear bar closing near its low. So a 2-legged correction, and now we're potentially resuming the trend. 65, a follow-through bar. You could sell below 64. You could sell below 65. You could sell the breakout point below the low. Bulls trying to buy the low, but fail on 66, and we get a downside breakout. However, it's a climactic breakout below a channel, and we get a bounce at the end of the day. For stop orders, you could probably buy 2. Like I said, low probability. You could buy above 3. 6, not great, but not unreasonable. And 17, maybe 18, maybe 20. If you're going to sell 33, you better be quick. 41, 42, 43, 44, 45, and then 51 is probably the best sell of the day, or higher probability, 53, 54. You can sell these closes all the way down. This is one of those days that was better for limit order scalpers. Traders, they see a big leg 1, maybe they sell a pullback, get the second leg. They say 2, 3, 4. They know we're going to get a second leg up. They buy the close of 5, betting that 6 will not be another strong follow-through bar for the bears. And then they get that. Maybe they scalp out. Maybe they hold, and then they scalp out somewhere up here. For limit orders, as far as just one easiest limit order trade of the day, probably selling above 45. I would think there would be sellers above here, but you shouldn't think of it as a limit order trade. You should think of it as a stop order trade. This is, one of the little secrets, I suppose, to trading is you look at Brad, you look at Al, and they're really good stop order, or they're really good limit order traders, and they're limit order scalpers, but they don't think of themselves as, or I'm speaking for them. I shouldn't be. But from what I've heard, and the way that the correct mindset seems to be formed, they don't think of themselves as limit order traders. They don't think of themselves as limit order scalpers. They think of themselves as stop order traders who are waiting on the limit order entry. So what I mean by that is, you know it's reasonable to sell the close of 45. It's a 5-bar micro channel, and so you know it's going to be okay to sell the close of 45. And maybe you sell some on 45, and you're willing to sit through a pullback. You know a pullback is likely. Your stop is up here, and then when we go above 45, it's still the same as just sitting through the pullback, except you're just entering up here instead of down here, just trying to get a slightly better price. But you should still think of yourself as a stop order trader who sold the close of 45 and manage it that way. The problem is when you try to get too caught up in the little details trying to limit order scalp and it doesn't end up working. What you have to do is think of yourself as a broader picture stop order trader, and that's what makes the limit orders possible. A trader who's buying the close of 5, they might not be thinking of themselves as somebody who's buying the close of 5. They might be thinking of themselves as somebody who thought, 2 is a possible low of the day and they're getting a better price and they're still taking a chance. They might think of themselves as somebody who bought above 3 and they know that this is going to get a second leg. They just don't know when. So they're thinking of themselves as somebody who bought up here, except they're just using a different entry. So you should always, always, always think of yourself as a stop order trader. It's just that your entries vary. The daily chart, a couple bear bars closing near their lows. We're going to get to moving average. Probably, I would imagine we're going to get to 6,000. I don't know if we bounce a little bit first and do it in 2 legs, but this is enough. Let me get a sip of water. This is enough for a second leg down. The weekly chart, becoming a bear bar. We did go below the prior day's low, or the prior week's low. So imagine, probably buyers somewhere down here for a second leg. And then the monthly chart becoming a bear close. Again, not a lot of traders willing to buy all the way up here above this climactic bar. They know they'll probably get a better price. So usually when you get this climactic of a bar, 60% chance of one more leg sideways to up, 60% chance you test towards the bottom. So it's possible we get back into this area. All right, that is going to be it for this video.